Chapter 2 Homework. Question 1. Lilliebridge and Friends Incorporated provides you with the following data for its single product. It gives us the sales price per unit, fixed costs per quarter. So the totals they give us are $1.5 million in SG&A, which is selling, general, and administrative, and $4.5 million in manufacturing overhead. So these are costs per quarter. That means they're the total costs that we incurred. We compare that to the variable costs right below: direct labor, direct materials, manufacturing overhead, and SG&A. And these costs are per unit. So direct labor per unit is $8. Direct materials per unit is $11. Manufacturing overhead, the variable portion, is $9. And the variable portion of SG&A is $5. And the number of units produced per quarter is 500,000. So now we have to calculate the different costs per unit, assuming that the company made 500,000 units this quarter. So for these, I'm going to reference the book because I often don't remember what these costs are, and we don't really have a need to memorize them for our purposes. So for the first one is prime cost, and that's shown on page 51 of the textbook. And we see that it's the sum of direct materials and direct labor. From the fact pattern above, we see that direct labor is $8 and direct materials is $11. 8 plus 11 equals 19. Next is contribution margin. That's discussed on page 63. And the formula for contribution margin is sales price minus variable costs. The variable costs listed are right here. We have 8 plus 11 plus 9 plus 5, and that gives us 33. So we do the sales price of 50 minus variable cost of 33, and our answer here is 17. Next, we look at gross margin. Gross margin is found on page 62, which tells us that the formula for gross margin is revenue minus cost of goods sold. So the revenue from one item sold is $50. But what is cost of goods sold? Page 62 also defines that term, and it says that cost of goods sold is the same thing as full absorption cost. Page 60 talks about full absorption cost, and it defines it as all variable and fixed manufacturing costs. So remember that manufacturing costs includes direct material, direct labor, and manufacturing overhead, but it doesn't include SG&A. So what we need to do is add up the variable costs that are manufacturing costs, and also we need to convert the manufacturing overhead, which is fixed, into a per unit. So if we take this $4.5 million in manufacturing overhead and we divide it by 500,000 units, we get $9 per unit. So to calculate our gross margin per unit, we have $50 sales price minus our $9 manufacturing overhead and our direct labor variable cost of $8, our direct materials of $11, and our variable manufacturing overhead of $9. So that's 50 minus 37, and that gives us $13. Next is our conversion cost per unit. Conversion costs are discussed on page 51, and page 51 tells us that conversion costs include direct labor and manufacturing overhead. Remember, the term means that direct labor and manufacturing overhead are what's needed to be applied to direct materials to be able to convert the direct materials into a finished product. So we add our direct labor of $8 plus our variable manufacturing overhead of $9 and the fixed manufacturing overhead of $9, which we calculated earlier, to arrive at $26 conversion cost. Next is variable cost per unit, and that's just all of the variable costs, no fixed cost. So we're going to add $8 of direct labor plus $11 of direct materials plus $9 of variable manufacturing overhead, $5 for variable SG&A, for a total of $33. Full absorption cost, we talked about this earlier on page 60. Full absorption cost is the same as cost of goods sold, which we calculated on part C. So that's the part in the parentheses, which is 9 plus 8 plus 11 plus 9, which is $37. Next is variable production costs. So we're not looking at fixed costs for this one, we're looking at variable. And then we have to determine which costs were incurred to produce the item. So for the variable costs, we have direct labor, direct materials, manufacturing overhead, and SG&A. The first three are used to produce the unit, and then SG&A is not incurred to produce a unit, but rather to sell the unit. So we're not going to include SG&A in this amount, but we include the other three. So we have 8 plus 11 plus 9 equals 28. And finally, we have full cost per unit, which would include all of our variable costs and fixed costs. The variable costs are already given to us as a per unit cost, and we calculated the per unit cost of fixed manufacturing overhead. So now we just need to calculate the cost per unit of the fixed SG&A. So we're going to divide 1.5 million by 500,000 units. And that gives us $3 per unit. So now for full cost, we can add all of the cost per unit that we have. $3 per unit plus $9 plus 8 plus 11 plus 9 plus 5 equals $45 per unit. So those are all of the calculations if the company produced 500,000 units. I'll let you do the other column on your own. That's where the company produces 600,000 units. So you'll do all the same calculation. Variable costs are going to be the same amounts per unit. For fixed cost per unit, remember to divide by 600,000 units instead of 500,000 units. And follow the formulas that we just discussed, and you should be able to get your answers pretty easily. Question 6 is also very similar to question number 1, so I'll let you guys work on question 6 on your own. Next is question number 2. For this question, we have to prepare a cost of goods sold statement. A good example of a cost of goods sold statement is on page 55. So I'm going to use the cost of goods sold statement on page 55 as a and select my accounts accordingly. The first one is beginning work in process inventory. Then the next section is direct materials. We start out with beginning inventory of direct material, and then we add purchases to arrive at materials available. Then we subtract out our ending inventory to arrive at direct materials. The book calls it direct material put into production, but it's the same thing as direct materials used. Remember that for a manufacturing company, you're going to have 3 different inventory accounts. You're going to have your raw materials, then work in process, then finished goods inventory. So your direct materials are your raw materials, and then when you use the direct materials, they move into work in process. So you can call them either direct materials used or direct materials put into production. So that's one minor difference between the book and the problem that we're working. Another difference is the next line. In the book, the next 2 lines are direct labor and manufacturing overhead, which then gives us total manufacturing costs. On question 2, there's only 1 line. So for this, we'll just use the process of elimination. There is no selection for direct labor or manufacturing overhead. So it looks the best account name for this line will be other manufacturing costs. So we have direct materials used plus other manufacturing costs to arrive at total manufacturing costs. The next line is total cost of work in process, which is the same in the book. Then we have less ending work in process inventory to arrive at cost of goods manufactured. The next line is beginning finished goods inventory, then finished goods available for sale, and then finally less ending finished goods inventory. So those are all of the names of the accounts that we're going to use. So now we have to plug in our numbers. For this cost of goods sold statement, they give us some numbers here at the top. They give us beginning and ending amounts of direct materials, work in process, and finished goods. And they also tell us how much of the direct materials we used in the year, which was $525,000, and cost of goods sold was $1,436,000. So what we need to do is fill in what we know first and then try to figure out what the blanks are. So the first line is beginning work in process inventory, which we already know because it tells us at the top it's $62,000. The direct materials beginning inventory we also know, $36,000. We don't know purchases yet. We don't know materials available yet, but we do know what the ending inventory is. So that's $41,000. The fact pattern also tells us that we use direct materials of $525,000. And we know that the ending work in process inventory is $66,200. Beginning finished goods inventory is $42,500. And ending finished goods inventory is $38,200. And then the final number given to us is cost of goods sold, which is $1,436,000. So those are the 8 amounts that were given to us. The 6 amounts of beginning and ending inventories, and then the direct materials and cost of goods sold amounts. So now we have to see what we can figure out. We're going to use 2 different formulas throughout this problem. The first one is beginning inventory plus purchases equals cost of goods available for sale. Beginning inventory is inventory left over from the prior year. Purchases is what we purchased in the current year. And so those 2 amounts combined are the cost of goods that are available for sale in the current year. The other formula is beginning inventory plus purchases minus ending inventory equals cost of goods sold. We're going to use this formula or a variation of it. Remember that in an equation with 4 numbers like this, as long as we know 3 of the numbers, we should be able to figure out the 4th one. We can also rearrange the variables in the equation. So another version of the equation could be beginning inventory plus purchases minus cost of goods sold equals ending inventory. So let's start working on the direct material section of the statement. We have beginning inventory of $36,000. We don't know what purchases are, but we do know ending inventory is $41,000, and so our direct materials used is $525,000. So since we know 3 of the 4 variables, we can figure out the 4th one, which is P. So P equals $525,000 minus $36,000 plus $41,000 to give us $530,000. So our purchases of direct materials is $530,000. Next, we have to figure out what materials we have available. So we're going to use the other formula, beginning inventory plus purchases equals cost of goods available for sale. So $36,000 plus $530,000 in purchases is $566. Now let's move to the bottom portion of the statement. We actually need to fill out the bottom portion before we can figure out the missing items in the middle portion. For the bottom portion, we're going to use our formula with the 4 variables again, since it looks like we have 3 out of the 4 variables. Beginning finished goods inventory is $42,500. We don't know our cost of goods manufactured, and in this case, cost of goods manufactured would be the same as purchases of direct materials. Remember that this formula is very similar for all 3 types of inventory, but some of the accounts are titled differently. Beginning inventory is the same. Instead of purchases, we have cost of goods manufactured. Then we subtract out cost of goods sold, which was given to us. And our ending inventory, which was also given to us, is $38,200. So we move over the $42,500 and the negative $1,436,000 to the other side of the equal sign. So we have 38,200 minus 42,500 plus 1,436,000, and we get cost of goods manufactured of 1,431,700. Then we use the second formula. Beginning inventory plus purchases equals cost of goods available for sale. So that would be 1,431,700 plus 42,500 beginning finished goods inventory to get 1,474,200 in finished goods available for sale. All right, so we have the top portion of the statement done, the bottom portion done, and so now we just have the 3 amounts in the middle that are still missing. So for the third time, we're going to use our formula with the 4 variables. For work in process inventory, our beginning inventory is $62,000. We don't know what our total manufacturing costs are. In the formula that we've been using, total manufacturing cost would be equivalent to purchases. We have our ending inventory, which is $66,200. And we also have our cost of goods manufactured, which is equivalent to cost of goods sold when working with the finished goods inventory. So again, we leave our unknown variable, the total manufacturing costs, on one side of the equation, and we move everything else to the other side of the equation. And we get 1,435,900 as total manufacturing costs. So for the next line, total costs of work in process, we're going to use the same formula. We're going to use the shorter formula, beginning inventory plus purchases equals cost of goods available for sale, except in this case, we're going to have beginning inventory, which is work in process, plus total manufacturing costs equals total work in process. Beginning inventory of work in process is $62,000. We now know that total manufacturing costs is $1,435,900. The total cost of work in process is $1,497,900. And then finally, we need to figure out other manufacturing costs. Remember that manufacturing cost is direct materials plus direct labor and manufacturing overhead. In this case, they're not splitting up direct labor and manufacturing overhead, but we do have direct materials as a separate item. So it'll be direct materials plus other manufacturing costs equals total manufacturing costs. Our direct materials is $525,000. We don't know what other manufacturing costs are, but we do know that total manufacturing cost is $1,435,900. So when we move the $525,000 to the other side of the equation, we do $1,435,900 minus $525,000. We get $910,900. And that's the end of our question. It was a real doozy, especially since the names of the accounts didn't quite match up perfectly to the sample in the book. So we had to work through things. But once you understand the logic, at least you're able to work through it and understand what's going on. In my job as an IRS agent, I see different styles of bookkeeping on a daily or weekly basis. And every accounting system is just a little bit different. So it can be complicated. But if you work for a single company or perhaps a CPA firm and you work with the same clients year after year, then the first year it might be difficult to understand books and records. But once you learn it and take detailed notes, it gets easier in subsequent years. So that's the end of question 2. Question 3 is very similar to question 2, so I'll let you work that out on your own. Question 4. Otsego Industries manufactured 300,000 units of product. Then they give us total variable costs and total fixed costs. And then they say that they expect to only manufacture 255,000 units in the next month. And it wants us to calculate costs of producing these 255,000 units. So fixed costs are expected to remain the same, but as we know, the total of variable costs will change. So what we need to do is convert these variable cost totals into per unit amounts and then calculate how much the total variable cost will be under the new number of units, which is $255,000. So for direct materials, that's 6120. The column indicates that the number is actually in the thousands. So instead of 6,120, it's actually 6,120,000. But for simplicity purposes, I'm going to call it 6120. Direct materials used was 6120. I'm going to divide that by 300 units. Since we're dropping off the 3 zeros on the costs, I'm also going to drop off the 3 zeros from the number of units. I think the easiest way to work a problem like this is using Excel. So I'm going to enter these numbers into Excel. 6120, 4060, 1420, and 1300. So these are the total variable costs incurred based on 300,000 units. So we need to figure out the cost per unit. So that would be equal sign 6120 divided by 300 equals $20.40. And then I'm going to highlight this and drag and drop. So Excel does most of my math for me. So if I have a total expense of 1,300 based on 300 units, that means that it's $4.33 per unit. Next, we have to figure out what the totals are if we only produce 255,000 units. So I'll let Excel do the math for me again. $20.40 times 255,000 units is $5,202. Then I highlight, go to the bottom right corner and drag down, and those are all of my amounts. Next, I click the cell below these totals. I push the total amount, the sum amount equals, and it's 10,965. So my total variable costs is 10,965. Total fixed costs. The fixed costs given to us are $560 for supervisory salaries, $851.70 for plant utilities, $1335 for depreciation, and $568.30 for property taxes. And remember, fixed costs don't change depending on how many units you produce. It doesn't matter if you produce 1 unit or 1,000,000 units, within the relevant range, of course. And in this problem, it told us that fixed costs are expected to remain unchanged. So we take that total, and that's 3,315. Our total fixed cost is 3,315. Our total costs would just be our variable cost of 10,965 plus 3,315. So what you can do there is click on any open cell, push equals, click on the first amount, plus, then click on the second amount, then push equals, and it gives you the total, 14,280. And then finally, the unit cost. Let's click on another blank cell, push equals, and we're going to do 14,280 divided by 255. That gives us $56 per unit. That was number 4. It was pretty easy, and it was made even easier by using Excel. And finally, number 5. This is the last one that I'll work out with you guys for this chapter. I'll do part A, and you can do part B on your own. The question says that Tracy Packaged Snacks reported the following information for November. They produced and sold 320,000 units, and then it gives us per unit revenue and costs. It wants us to prepare a gross margin income statement and a contribution margin income statement. There are 2 good examples on page 65. And this problem follows these examples perfectly, so we're going to use these examples and format our questions the same way. So it starts with the gross margin income statement. The top line is sales revenue, then variable manufacturing costs and fixed manufacturing costs to arrive at our gross margin. It could also be a gross loss, but we can change that account if we need to. Then we have our variable marketing and administrative costs, our fixed marketing to arrive at operating profit or loss. So now that we have our accounts, let's begin with our calculations. First, we need to calculate the total sales revenue. We see here that we get $3.10 of revenue per unit, and we multiply that by 320,000 units to arrive at $992,000. Next is variable manufacturing costs. And remember that manufacturing costs includes direct materials, direct labor, and manufacturing overhead. That's $1 plus 25 cents plus 15 cents So that's $1.40. $1.40 times 320,000 units equals $448,000. Next is fixed manufacturing overhead. The fact pattern says that it's 90 cents per unit at 320,000 units. So all we have to do is multiply that out. 90 cents times 320,000 units equals $288,000. So our gross margin would be the $992,000 in sales revenue minus $448 in variable manufacturing and $288 in fixed manufacturing to give us a gross margin of $256,000. Next line is variable marketing and administrative. That's 10 cents per unit times 320,000 units is $32,000. Fixed marketing is 50 cents per unit times $320,000. So if we take our $256,000 gross margin, subtract out the $32,000 in variable marketing and $160 in fixed marketing, that gives us a total operating profit of $64,000. So that's the end of part A of question 5. I'll let you do part B on your own, which is the contribution margin statement. It's pretty straightforward if you follow the example on page 65 of the book. But to check yourself, the contribution margin should be $512,000, and the operating profit should be the same as it is under the gross margin income statement, which is $64,000. If you have any questions, please don't hesitate to reach out. Thanks.